All right. Good morning, everybody. All right. So, if you are new to the morning briefing, and just fill you in, this is designed to teach you how to prepare for the morning. So, I am going to give you a fish. Today, but the ultimate goal is to teach you how to fish. So, as we go through these data points, keep in mind these are the things that we want to cover each day. These are the things that you're going to want to approach each morning when you're trying to determine what's going on out there and how you're going to approach your trading day. Start out with a look of what happened in the overnight hours while you were asleep. Find some place that discusses what happened in Asia and Europe. We're looking at finance juice here. It's got a European market wrap, which is nice. It wraps up every session. So after the US session, there'll be a market wrap. After the Asian session, there's a market wrap. Last night, and it's still Europe is still open. Financials took a hit. So did travel and leisure stocks. That kind of gives us a little idea of what's going on, right? Because if it was tech or if it's finance, it's important. You're also looking for anything that stands out, any big news. The example that I normally give is, suppose, for an example, a ship got stuck in the canal and it was blocking all transport globally. Then that would be really big news. It would be in here, right? So you're not you're not on the hunt for just any random junk. Look specifically for something really big. If there's nothing there, then there's just nothing there. We do have a full house today. A lot of things on the agenda, some with high impact expectations. Right now, we're looking at FX Street, and it tries to warn you of the level of impact for the economic event coming out. Now, this is not always going to be accurate, right? Sometimes we will expect an economic report to have a lot of volatility and it'll come out like a dud and just nothing. And then other times there'll be like some random survey that normally doesn't cause any volatility at all, suddenly being the spotlight. But there is, historically speaking, some economic reports that 8 out of 10 or 9 out of 10 times will be uh, the catalyst of violence. So, this is pretty spot on. The darker the red, the more anticipated the impact. There is a meeting today in the White House with Janet Yellen, Biden, and Powell. Um, I think it's later in the day. Not quite for sure. We'll have to keep our eye on when that date gets set, that time frame. There's no expectation of a policy change, right? But we do have to be concerned about them deliberately turning the wrench and pushing the market in a particular direction. Next thing we always do is go to Market Watch. If yours is really cluttered like this, it's got everything turned on. The easiest way to get rid of all that stuff is just to uncheck everything and then turn on the Econo Day event. You can change these columns around and reorganize them. Makes it easy when you put your description next to time so you can see what it is and when it is. We have additional auctions today at 11 o'clock, and I've had people ask, why do I call it an additional auction? Well, there is the old phrase that the marketplace is nothing more than an auction, right? That the buying and selling within the marketplace, it is the auction. These are an additional auction. Thank you, Brian. I totally appreciate that. So Brian says the White House meeting is at 1:15 Eastern time. Dude, thank you very much. So I use the phrase loosely additional auctions because if we have auctions nonstop, right, that being the market, then these would be additional auctions. It's just a loose turn of phrase. It's a full morning, 8:30, 9, 9:45, 10, 10:30, 11, 11:30, and then 3 o'clock. I can't tell you how many times I've seen a market right at 11:30 when these additional auctions hit to change what it's doing and start doing something else, especially on Mondays. The thing about a Monday, and today being a Tuesday after a holiday, still counts for the same kind of logic that we're about to discuss, is that when the market is closed for a weekend, whether it was an extended weekend or not, price discovery has to happen on in the market when we open back up again. Should that be on Monday or like today, Tuesday? If you subscribe to the theory that everything you need to know is priced into the market and the market hasn't been open for 2 days, or in this case, 3 days, then it has a lot to price in. It can take 15 minutes, it can take half a day, right? But all of the information needs to be priced into the market. So on the first day back, we generally expect a price discovery for at least the first 30 minutes or so. And what ends up happening is a lot of times we get a Monday that is violent. Maybe it has some range, but it doesn't really break out in trend unless some news comes in and kicks it into that trend. So if we have this anticipation of a range morning and we're looking for that ranged morning to end, I would be focused on these lunchtime windows, right? 11 and 11:30 on the dot. Like no kidding. If it's 11:07 or 10 after 11 and you haven't seen anything, that's fine. Just shrug and move on. It means it very likely didn't have any impact today. Remember, it doesn't promise that there's going to be an impact, but do not assume today that price is going to set in its lunch range and do what it normally does at lunch, which is consolidate before making its afternoon moves. Not today. All right, so that brings us into the charts. It is worth noticing before we go anywhere, let's just stay on the daily chart for a moment. If you're a day trader, you really need to take the opportunity to go out to a daily and a weekly chart. Just take a look around. Maybe there's nothing there. Fine, but at least you looked, right? A phrase I like to use all the time is if you don't look, I guarantee you, you will never find anything, right? Maybe you see something, maybe you don't. But if you don't look, then I promise you won't find anything. So what's out there to see? Well, we have the anchored VWAP that started at the first of the year. That's when I anchored it, January 3. We're still underneath it. We're quite a distance away from it. What else do we have out there to see? We are still down on the year, but very close to being flat percentage-wise from a 12-year mark. All right, if I was to turn this chart into a percentage-based chart, you can see we're almost flat on the year. Pretty close. I think we got a lot closer to it in the overnight hours and then drifted back from it. So we almost got to zero on the year from where we were 12 months ago, right? First we were up and then we were down and then we laugh and then we cry. One thing we want to take a look at while we're on this daily chart is the size of the range this week. Now remember, this is a 4-day week. So it is important to realize the volatility measured for this expected move is only measuring 4 days. You want to take that measurement and compare it to last week's measurement. So last week was much shallower. It was much less of a range, and it had 5 full trading days. They anticipated so much volatility this week beyond last week's levels that the box is even greater, right? One less day and almost a third more expected move in there. So they are anticipating a lot of volatility this week. Just a nice, easy glance at something like that, as simple as just drawing a box and comparing it to last week's. We are done with OPEX, right? Last week was options expiration. Not last week, it was a week ago. The third Friday, right? 1, 2, 3. So take that out of my notes. That was 2 weeks ago. Never mind. We still got a lot of focus on this rally. If you start looking at those rallies with a little bit of background and perspective behind it, This rally off of the lows, 69 trading days. This rally off of the lows, 26. This decline from the highs, 34 trading days. And this decline off of this high, 35 trading days. There is an expectation that we're going to get at least a good 10 to 12% rally before we roll over. It doesn't have to, though, right? You got to keep that in mind when you're doing technical analysis and you're measuring your peaks and troughs. Each pullback and then each impulse down lower is expected to maintain its distance. And then if that distance gets longer or shorter, then it is explaining to you, or it's showing you that the rally is decreasing, or that the trend is decreasing or increasing, right? If the size happens to be increasing, then it provides some clues or some context. We do have some critical ranges. The cyan line that you see here is the 10 period daily moving average. We are back above it. We got back above it last week. It was during that crossover that I pointed out. We were in a TRB, right? Posted all those charts of the fangs, or the monsters of tech, so that we were all able to capitalize on this rally up. And now we need to focus on how much of this rally is left before we roll over and make our next leg down. This is the linear regression drawing line that we've used for a couple of weeks in a row, occasionally pointing out these swing highs and swing lows, and having the discussion that at some point we wanted to start seeing higher lows and higher highs. So we do have our higher highs. We don't have a full set of higher lows yet. Need to see how this current pullback comes into play. But there's every expectation when you're at the bottom of the range that you make it back towards the top of the range, unless we are continuing to trend, right? So in a trend, you only pull back about a third, and then you continue that move to the next third and the next third and the next third, right? We're talking about that part. So we're over 2% above the daily moving average. But on the weekly chart, we're still underneath it, although we're getting back towards the flat side of it. Our expectation for the day, well, we can only do three things, right? Stay range bound, break to the upside, break to the downside. For our range case, we want to completely ignore Monday. And believe me, I don't say that lightly. I don't like to ignore data, right? Just turning a blind eye to it and saying, pretending it's not there doesn't make any sense, right? Why would we ignore data? So perhaps we could find another way to say it. We don't want to ignore data. Just tuck Monday in with either today's price or with Friday's price. Lump it in there one way or the other, right? And if you do that, what you end up with is we closed Friday, and here we are Tuesday, and all of this in the middle, you could just consider all of that Globex, even though, yes, I know technically we were open in the futures on Monday. Just incorporate all of that, and our range would be from our own Globex low to the high of the Globex from Monday. That's zone one. We would still be focused on all of Friday as our trading range for today. So if we stay inside Friday's high and Friday's low, then we're range bound today. It would be considered a range day, an inside day. And then, of course, if we break out of that, then we're focused on an inside day breakout. So zone one would be from the high to our Globex low. Zone two could be considered from our own Globex low to Friday's low. And there are pivot points worth focusing on, even within that range, like Friday's open, Friday's close, the RTH or the Globex low of Friday. All of those would be worth focusing on as well, right? Those pivot points are inside of our range base case. And we have every expectation that this is going to be our day, right? Except that we have a lot of economic events today that could push us out of this. So kind of game that out. If this is our range and we want to focus on the other two things, we could break to the upside, we could break to the downside. We got an ADR of 2.7. So from where we opened to Globex, a 2.7% move breaks us out of the top of the weekly expected move. That would be 42.68. Just round up because the ES futures don't go to 0.81. So 42.69. Remember that the ADR is not extreme. That would be our normal, right? So if we turn bullish, just a good normal average bullish trend day should get us around the expected move top. If we're looking for an exaggerated move above and beyond the norm, then at the very least, you want to take the ADR and add another 50% of it, right? So say take 2.7, cut that in half, add that half to the current ADR. Napkin math in my head says that puts us around 4%, right? So from the close, a 4% move would be 43.30-ish, right? 43.40 actually is a little bit closer. So if we were to get just wild and crazy, 43.40. I don't expect that, right? Now, of course, the dominoes could line up that way. If all the economic news that comes out today is back-to-back bullish, then yeah, we could totally see a move like that. But 12 hours has already passed. So if we were going to get some of this 2.7% ADR on the day, then it really needs to get its butt in gear, right? We'd have to get through our own Globex high, break through Friday's level, and then really get after it. It would not be subtle. If we're going to hit these levels, it'd be lit up like a Christmas tree all across the board. Focus on the downside. 2.7 is the ADR. So from the open, 2.7 gets us outside the bottom of the weekly expected move and lands us at around 40.50. It's almost in the middle of Friday's lowest point and the bottom of the weekly expected move. If you were to split the difference between those, that really looks like where we would line up. And it actually is an institutional pivot point. It is the close from Thursday. See if we get that line lined up. Yeah, pretty close. And that would be 40.50.75. So yeah, 3 ticks off. That's not bad. But remember, getting to the bottom of Friday would be the bottom of our range. So our ADR for the day basically would be the bottom of Friday. And if we were going to go above and beyond that, because the ADR is considered the normal move, then you would want to measure a 4% move to the downside for any consideration of an outsized move. And either side we happen to break out of, if we break out of the top or if we break out of the bottom, an inside day breakout will be a rally performance in everything else too, right? So the monsters of tech will all be doing that. You'll have a continuation of the trend from that trend line breakover that we called out last week. All right, so we're looking at a 10-day, 30-minute chart. We got a volume profile and a TPO profile, time price opportunity, TPO. One thing you want to focus on is how wide is that box? The box is demonstrating where 70% of all of the volume is located. Now, it makes sense since most of the candles are within this range that most of the volume was in that range. What's worthy of noting is this high area of volume here around 41.25-ish. This area, there was no candles in that area prior to our current time frame. All right, so all of this volume here, that last little bit in Friday, maybe a little bit of it this morning. That's it. That's a lot of volume in this little bit of time frame, right? And you can tell it was a little bit of time frame because the TPO is very shallow still right there, right? So we got a lot of volume in that area, but we didn't spend a lot of time in that area. That's why looking at both of these together often provides a little bit of insight. We are outside the box. We always want to focus on where is price in relation to the box. When we are outside of the box, we have every expectation that price is going to come back down into the box. It doesn't have to. When we are outside of the box, we want to ask the question, are we moving back towards the box or are we moving away from the box? So we're looking at a 5-day, 5-minute chart. We call this mapping out the 5x5. There was a carried forward point of control, but we hit it in the overnight hours. So now it's no longer something we need to carry forward. I actually have mine set to more than 5 days just so we can kind of pull it back and see if there's any untouched point of controls that need to be carried forward. But really, you just want to leave it set at a 5x5. So for an example, this point of control down here is still an untouched point of control. That day closed, that point of control would be carried forward, and we have not yet revisited that point of control. While we're on this 5-day, 5-minute chart, it's worth pointing out the trend to the upside, the topping pattern, and now we're rolling over a little bit. But keep in mind that all of this price action that you're looking at should be considered all of a Globex, right? That's holiday stuff. That's the overnight trading from last night. Just consider the market has been closed since Friday. And I know that that's not technically accurate, but that's how you want to see it, right? So all of this would just be considered closed price action. It's like Globex price through all of it. And that this topping pattern could be no different than a normal market that would normally end, go into the Globex, show some topping pattern after having made moves like we made last week, where our low was 38.70 and our high hit 41.62, right? Because that last little bit that we did was a part of the weekend Sunday night into Monday, Monday night into Tuesday. So this could continue the move. Remember, trends need a pullback. Now, if we try to game it out, if we are to make the argument, do we really think it's going to be bullish or do we really think it's going to be bearish? You do have to have a little bit of a consideration for everybody on one side or the other. So everybody is saying the rally's not done, or the bear market's not done, that this is nothing more than a bear rally, that bear rallies can extend for 2 or 3 weeks, that they can make, 12 to 20% moves, that everybody's still looking downward, and that sure, take advantage of this short-term rally, but stay on the short side predominantly. Well, if that's what everybody is doing, then don't be surprised if we get the opposite of that, right? Even JP Morgan over the weekend came out with one of their publications and says, this is just a bear market rally. We're just rallying up. We're not done with the shorts. We're not done with these lows. Well, the guys, those analysts, they get it wrong. If you keep track of what they say each week, one week they'll say one thing, and then the next week they'll say completely and absolutely the opposite thing. So one thing you always want to focus on is, what's everybody's base case? What's their argument at the moment? So if everybody out there in the analyst world thinks that this is just a little bit of a bear rally and that it's going to be short-lived and we should sell the rip and reload for another run towards the bottom, give some consideration to the idea that if you catch everybody off sides, that we can continue the move in the same direction, just because all those shorts are going to get squeezed and they're going to have to buy back, and that will fuel the rally even more. Right? And it would be a hard, violent rally if you catch that much of the market offside. All right, so we're looking at the Nasdaq. The cyan line is the 10 period. We are a considerable distance away from it. Price does not like to get too far away from that 10 period daily moving average before pausing or consolidating and letting the moving average get caught up, or pulling back and coming back down towards that moving average, one or the other. Right? There is the argument that we have turned over, and we've started to get our first set, but we don't have a full set of higher highs and higher lows. We just don't have them yet, right? We've only got a higher high at this point. I say only, but that's the first higher high we've had in a considerable period of time, right? So it has a lot of weight behind it. I will continue to bring in the argument that we saw the plunge protection team step up when we hit that 20% benchmark off of the highs, and everybody started talking about the S&P slipping down into a quote a bear market because of that technical ring. We've seen the Fed step up that day, right? We've seen them actively participate in the market, going on to the media sources and doing what they do to stop the market from falling. So it seems like they're willing to play a little bit of a game, and we'll see how good they can do it, of keeping the market above that benchmark while also keeping the market from rallying all the way back up to its previous levels. So if this thing gets too bullish, they're going to find a way to whack it back down again. Looking at the Nasdaq, distance from the 10-week, we're still underneath it, and we are below it by more than 2.5%. For the daily, we are above the 10-day. We knew that because the cyan line is right there. And we are 3% above that 10-day moving average. And if you look back on the year, every time the Nasdaq got more than 3% away from the 10-period moving average, it paused, consolidated, and or pulled back the other direction and came back towards that 10. Right? So it's not just my bias or my assumption that price doesn't like to get too far away from the 10. I built this indicator so that we could see how far price gets away from that 10. We're there. So we have an expectation that price is going to pause here, consolidate, and or pull back towards that 10 again. For today, we've only got 3 scenarios. Stay range bound, break to the upside, break to the downside. With those scenarios in mind, first start with what we have, our own Globex low to the Globex high. All of this discussion for the range would encompass all of Friday. So Friday's Globex low all the way up to the close of Friday. But we're going to just run it over to our own Globex low here. All of this would be the range base case. Break that down into zones. You do have 3 zones that you could focus on. Friday's low to Friday's RTH open or cash open. From the cash open to our Globex low, and from our Globex low to our Globex high. Those 3 zones would be a part of the argument for today's range day. They would also be pivot points that we would focus on, first touch plays, either running against the grain or playing short duration, short term contrarian trade setups. For a move to the upside, we're going to have to get through the collection of pivot points from the close, our own Globex high, the Globex high from Sunday night, and then a move to the upside. We've got an ADR of 3.6. So if we take it from the white line, basically either the white one or the green one, because it'll be the close or the open. They're close enough that it won't matter. $3.6 gets us around 13.18, excuse me. So we could move that far today and it wouldn't even be considered extreme. It would just be a little bit of a shrug. Like, yep, we moved our ADR today. 13.182. There's a lot of pivot points and a lot of trash to get through if we were to make a move like that. Flip it over, take it the other direction. That same argument, but going the other way. $3.6 to the downside. We would still be inside of Friday's price action, surprisingly enough. 12,275 is pretty close. That would be our downside benchmark. And again, that would just be normal, right? We could move that far and it wouldn't be considered extreme. So a break below Friday's level would be an inside day breakout. We would anticipate picking up some speed, increased violence. We have the 10-period moving average underneath us down below that area. So first touch play would come into effect on that. And for that argument to the upside, once we break through our own Globex high of Sunday night or Monday's pre-market, however you want to see it, pretty much smooth sailing up to the pivot point. If we look at the volume profile, we don't have as much volume at that level as we do on the ES, right? Remember, I pointed out TPO was really short, but volume was really high at this level. We don't have that argument here. There is a considerable amount of volume showing up in this time frame, considering that we were closed through all of that, but nothing extreme yet. There is a significant level of volume support at 12.6. That support doesn't have a lot of validity to it, right? We're just talking about old volume nodes. So we recognize that it's there, but it's not like a handrail that you would want to lean on. Don't give that a lot of trust. It's just a pivot point that we would focus on with an expectation that if price gets there, there's likely to be some reaction out of the market to that. And we could anticipate the beginning of a little bit of support, but it would need to validate and prove itself. We are outside of the box, right? And the box here is much wider than the box is on the ES. But I use the word much wider. I shouldn't. It is just wider, not significantly wider. It doesn't seem like it. But we are outside of the box. And when we are outside of the box, we have an expectation that we are going to get back to the box. It doesn't have to. So when we come out and we recognize that we are outside of it, we want to ask the question, are we continuing to move away from it? Or are we moving back towards it? At the moment, we're moving back towards it, right? Continue to focus on where we closed Friday. Keep that point in mind today a lot. There is still that untouched point of control at 12.58. And there is one, although I wouldn't really focus too much on this one, there is one from Monday over our head at 12.85. It's worth noting, right? Just so if you see price moving in that direction and say you're thinking about getting into a trade and we're right underneath that level, that maybe you don't get the trade until we react at that level. All right, so Bitcoin is up. The benchmark that I've been seeing tossed around is 3,100. So everybody is talking about, hey, it's back above 3,100. Uh-huh. Sure. One thing it is worth noting is that the range on Bitcoin is more sideways, while the range in the S&P and the Nasdaq is more of a angled channel downward, right? Now remember, when it comes to this kind of analysis, when you have a falling wedge or a falling channel, it's a topside break that you expect, right? Not a downside break. Now, that doesn't mean that it can't break out of the bottom of the channel. Of course it can. Price can do whatever it wants. But generally speaking, the focus would be on looking for price to break to the upside of those channels. Whereas when we're sideways, we're just left looking for which way do we think we're going to go here. Continue the upward bullish move or fail and take it back the other direction. There was quite a bit of news about the Russia sanction this morning. But if you read some of the fine details, they're talking about, oh, those sanctions won't kick in for 6 months and it's exempting the pipeline. So the sanctions are only going to be on ship transfer and it's only X percentage of that ship transfer. So it sounds good when you just read the headline, but when you dig into it a little bit, it didn't really seem to have much teeth to it, especially if it's going to kick in 6 months from now. Which, by the way, if you think about it, that's right before things start to get cold again and where a lot of countries are actually going to need the energy. People can suffer through hot weather and complain about it. When it comes to cold, at some point it gets too cold. So there is always this expectation that stocks and bonds are like a teeter-totter on the playground, and that if one is going down, the other one has to go up. But that is not true. We just have the expectation that most of the time they are an inverse product and that one will be going up while the other one goes down. But make no mistake about it, they don't have to do that. Right? Continue to focus on the dollar this week, especially with what we read about what happened in Europe or what is happening right now. If you look at the sectors that are doing good this morning in Europe and the sectors that are doing bad, finance got whacked in the overnight hours. For our market, we need finance or tech if we're going to see the S&P rally. If we're going to see the market continue this rally from Friday, we need one of those two sectors. So if finance is getting whacked in Europe, it's very likely that finance is going to get whacked here, at least for the start of the day. Remember, everything can change because we got a lot of economics on the agenda today. So it can all turn around. But for the moment, keep your eye on the financials. That's XLF and KRE. Those two ETFs work really good to keep track of the financials. And then pick a bond. It doesn't really matter which one. You can pick the 30-year or the 10-year. I tend to bounce back and forth between those two just because I want to look at both of them. Um, Bouncing back and forth is necessarily a good thing, right? You should just stick to one until you're really comfortable with it and then perhaps give some consideration to the other one. If you were just to pick one and you're just starting out, the 30-year would probably be a little better, right? A little more structure behind it. The VIX continues to be significantly useless, and I'm not even joking on that. The VIX has been a complete and total dud. So you got to watch the dollar, the bonds, and the oil more than the VIX. The VIX just really hasn't been helpful. But if you are focusing on the VIX, then keep track of the VVIX. If you're unfamiliar with this product, it is the volatility of the volatility index. To put that into terms that make sense to people, if you're looking at SPY and you're on a daily chart and you want to know, say, how much volatility does SPY have, then you can go to a volatility indicator, right? You bring up something like implied vol. That makes perfect sense. I don't think anybody would argue with this, right? How volatile is SPY? Oh, well, let's bring up the volatility indicator. It's got a 23 vol. And this will tell us that SPY is considerably volatile right now. Volatility is another word for movement. The movement measured, generally speaking, is from the highest to the lowest point. When volatility is going up, the distance between the highest and the lowest point is expanding. That the daily candles or whatever candle you're measuring is getting bigger and bigger. And we see that, right? Big red bars, big green bars, lots of volatility. Well, when you go and look at something like the VIX, you can't use a volatility indicator, right? You can't put implied volatility on the VIX. It doesn't work that way. So if you can't use this, how are we to determine how volatile the volatility indicator is right now? How volatile is the VIX? That's where we use the VVIX. And right now, looking at a 1-year chart, we are lower than we have been in the last year. So volatility is really low, implying that nobody is concerned. Volatility is low, everybody's happy and warm, fuzzy feelings. I don't know about you guys, but I don't have that warm, fuzzy feeling. It doesn't feel like volatility is low, right? So, volatility right now is a real useless tool at the moment. This directly affects all kinds of things, including options. All right, so we're looking at the S&P 500. We want to knock this down to pre-market change percent. I don't want 500 names, so I'm going to try to adjust this closer to 100 names. 101, not bad. It gets a little tricky. So now we're looking at around 100 names. The thing that I adjusted is market cap. How many names do I want to see? I want to see the top 100 names sorted by market cap. There's a lot of gray here. One way you can adjust all of that gray is to change the multiplier. And now we got a better perspective of what's going on. The size of these boxes show you the size of the market cap, right? So a big box has an expectation that that is a mega cap company, what we often refer to as the monsters of tech: Apple, Microsoft, Google, Amazon, Tesla, Facebook. And we can see that generally speaking, it's just a whole lot of weakness out there, but nothing really negative. Plus or minus 18% is nothing, right? My benchmark starts at about 0.5. That's 0.5 up or 0.5 down. I don't really care, but that's where my benchmark starts. So when I see something at, a tenth of a percent or even a quarter, that doesn't carry any weight. Normally, a heat map like this, I would give it more validity, but considering it's the 3-day weekend and we always have to be concerned about the platform that we're using, we don't know if some of these names have had volume yet this morning. And so the positive numbers that you see could be from Friday after hours, not from this morning pre-market, right? You'll see that a lot of times on, say, TrendSpider. TrendSpider will show you that we're up this morning in the pre-market, but then if you go and dig deeper, it's really still recording after hours from the previous day, not pre-market from today. All right, so we're looking at the Nasdaq 100 pre-market. We don't need a filter. We're just going to adjust the color scheme a little bit. And again, the big names stand out, and it's a mixed bag with nothing really extreme. A couple of names are up, quite a bit. Adobe, Inuit. So there are some names that are moving around, but again, check those, dig a little deeper. I like to be able to put things into perspective. If we're bullish this morning, by how much, right? So if we look at something like the S&P 100 and we ask how many names are up at least a half of a percent this morning, only 4. And 3 of them are energy names, right? You got Tesla and then 3 energy names: Chevron, ConocoPhillips, and ExxonMobil. Well, that's significant. How many are down a half of a percent? Maybe that would give us a little more insight. So S&P 100, how many names are down at least a half of a percent? 25. So 25% of the S&P this morning is down at least a half of a percent. Now that provides a little bit of context. It's not enough for me to get bearish, but it's enough for me to start focusing on what is not down this morning, because that may be the driver, right? We may want to focus on those for an opportunity to trade. I don't like to short from the lows. I'd rather hammer down on something that has made moves to the upside if I expect the market to go down, rather than focusing on what's already down the most and thinking that it's going to go down even more from there. The significant difference between the S&P and the Nasdaq is that the Nasdaq 100 does not have financials. Remember what's going on in Europe this morning. The financials sector got whacked. It's one of the 3 that got whacked. So looking at the Nasdaq 100, how many names are down at least a half of a percent? Only 10. So the ES has more names that are down this morning than the Nasdaq. Let's circle back to the ES for a minute. What sector is in there the most? Well, I don't know about most, but there sure is a lot of finance in there. Citigroup, Bank of America, Morgan Stanley, Goldman Sachs, JP Morgan, Charles Schwab, American Express, Wells Fargo. Finance, 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 finance. Remember, if we're going to see a rally in the S&P and the Nasdaq today, we need at least one of the two sectors, tech or finance. Names that are down in the Nasdaq, out of those 10, we want to look for any particular sector that stands out. I'm seeing some tech names in there, which makes sense because this is considered the tech index. But I also see a couple of retail names in there. Dollar Tree, eBay, Walgreens. Now, it makes sense because Dollar Tree, for an example, or retail last week was doing really good. Names that are up in the pre-market in the Nasdaq at least 0.5%. I see a lot of China names in there. And that makes sense too, considering the steps that China is taking on the stimulus, and they're slowly starting to talk about reopening certain sectors or zones. Just continue to approach these China names with caution because they still are dealing with lockdowns and reopening. The whole phrase of those, right? The reopening list of stocks, seeing things get locked back down again, supply chain issues, blah blah blah, on and on and on. That's what I got for you guys. Be careful, be safe. We have a lot of changes coming in this week or in the next few weeks. We're going to be doing a lot of work on the penny stocks room. So there's not going to be anybody streaming in there. But that doesn't mean that we can't help or answer questions, provide guidance. So for those of you in the penny stocks room, the chat is still there, right? Feel free to ask questions, seek out guidance. We'll do our best to kind of get you pointed in the right direction. And otherwise, guys, I'll see you all tomorrow.